without further ado, take it over, Hasani. So yours.
Thank you, brother. Thank you. Appreciate you, Sean. And then for the TBD next gen wealth. Is that right? Is that how you say it?
Yeah,
Um,
Gen Wealth.
yes, TBD Gen Wealth. Just want to make sure I pay respects to y'all just for the fact that you guys have a name like TBD Gen Wealth to even think to have a foresight for somebody in the future that you don't even see or have yet. That's power within itself. So just a little bit about me. So I'm actually born and raised out of San Jose, California. Oldest of three, played sports growing up, and what ended up happening to me was I thought I was going to go to the NFL. I end up getting hurt, lose my contract, come back home, and I fall into finance because my dad has a heart attack on the job. My mom's in real estate. We go from over $250,000 a family to $30,000 a year. Now, mind you, my mother had her master's. My dad had his bachelor's. I graduated with my bachelor's, and yet we all still struggle in that household as if none of it mattered. So that opened my eyes because I'm like, okay, where did I miss? What's going on here? And so that's what made me even be open to other avenues when it comes to finances, compared to what we were traditionally taught. So I went down this path and I worked hard in this path. I've been working in the industry since December of 2008. And I would say more so 2014 is when you know how you can hear about concepts, but you don't really dive in. From 2014 is when I really got serious about infinite banking, I would say, especially when I realized how I could connect it to trust. Then from there, as of January of this year, I got serious with Instagram and social media and making this information available to more people because I realized more people need to hear about it. So with that being said, we're here now, and my main focus is teaching people about not just insurance and investments, but specifically infinite banking. And just to get a temperature of the room, how many of you guys in the audience have heard of infinite banking before? Anybody ever heard of it before? No? All right. Well, let's do this. Let's test. For those of you who've heard of it, uh, go ahead and raise your hand if you've heard of it before. Okay, raise your hand if you have not heard of it before. All right. And then I was gonna say, raise your hand if you just ain't gonna participate. Right? So I'm messing with y'all. I'm messing with y'all. You know, I like to crack on folks and joke around and things of that nature. But Sean said something very, very important, y'all. He said that his understanding of insurance was that when we pass away, our family benefits. There's a reason why he thought that way. There's nothing that happens in a vacuum. There was a time where insurance was pushed into certain communities, but only a certain aspect of insurance. So we weren't taught about other things. So with that being said, that's why I fought so hard to make sure I can make this available to so many other people. And so with that being said, if you guys don't understand infinite banking now, here's what we're going to learn from this presentation. Number one, you're going to learn what infinite banking is, the details of how it can work, but more importantly, how you can make money from it. Okay. And just to get some more temperature of the room, can we type in the chat where we from? What state you guys from? Because I heard y'all got people in all kind of different states and everything. What state is everybody from? Type it in the chat for me real quick, just so we can see where we at. So we got Maryland, New York, DC, okay, Ohio, California, okay, all right. You know, folks be making jokes that SoCal and NorCal could be two different states. Uh, okay, and we got New York again. I think that's everybody. So yeah, well, most definitely. Well, I'm glad to see that everybody, you know, all this different representation in the house. Definitely appreciate y'all. Well, let me go ahead and jump into it. Hold on. Totally. You know what it is. You know what it is, right? So here, let me go ahead and jump into it, y'all. Now I'm gonna go ahead and warn everybody now. and let you guys know when I do the presentation, I definitely ask people questions, definitely get people involved. So if there's anybody who probably ain't up for talking right now, just send me a personal message so that I know, so I don't pick on you. But other than that, I make sure I talk to everybody and get everybody involved, because I realize people learn more than just sitting and listening. They learn by doing, they learn by seeing, and they learn by participating. So because of that, I try to make sure that people can participate with me. So is everybody in agreement with that? Everybody okay? Drop a Y in the chat if you're good with that, y'all. Drop a Y in the chat if you're good with that. Okay, solid, solid, solid. Okay, solid, solid, solid. Perfect. Okay, so with that in mind, we good. Okay, so with that in mind, let's jump into it, y'all. With infinite banking, what is infinite banking? Infinite banking is your ability to leverage your money with an insurance company so you can spend the same dollar twice. I'm gonna say that again. Infinite banking is your ability to leverage your money with an insurance company so you can spend the same dollar twice. So what that would mean is, how much more beneficial would your life be if you could spend the same dollar twice? Right? What more benefits would you receive if you could spend the same dollar twice? So that's pretty important. But I do want to make sure that I let people know some of the information you're going to hear is unconventional. And this strategy is meant to enhance, not to replace what it is that you do, unless you're investing in 401k. And we want to make sure we have two different types of mindsets. Now, let me speak to my fellow Californians. When we're talking about a banking mindset, what is the number one asset that a bank has? Or no, we want to say that if Aquila were to put money in the bank, let's say it's in a savings account, is that an asset for the bank or a liability for the bank? If you think it's an asset, type A. If you think it's a liability, type L. So again, Aquila, let's just say she puts in 100 grand in a savings account with the bank. Is that an asset for the bank or a liability for the bank? So the most popular answers we usually get is, oh, there we go. The most popular answer we usually get is asset. Now, here my job is to challenge you to think different. Listen to this, y'all. If a savings account is an asset to you, then it can't be for the bank as well. Let me give you perspective. If Aquila puts 100 grand in the bank, don't they have to pay her interest? Right? So if we go back to the definition of asset and liability with Robert Kiyosaki, what he says is an asset is something that adds money to your account. A liability is something that takes money from your account. So if we just go off that basic principle, now let's think from the bank's perspective. Aquila puts $100,000 in her savings account with our bank. So now we got to pay her interest on that money. Therefore, it's a liability. Does everybody understand that? Type of Y if you with me still. Right? So Aquila's 100 grand is actually a liability because the bank has to pay interest on it. Now, before anybody argues, we all know the banks don't pay us nothing. But accounting wise, the principle is still they got to pay. So now, with that being said, though, check this out. This is why we say it's a banking mindset. The banks are in business to convert their liabilities into assets. How do they do that? Now, how they do it is probably why most of you say that a bank account is an asset to a bank. I come along to the same bank and I say, hey, I'm a business owner, entrepreneur. I want to open up my own business. I need $100,000. They're going to loan me the money that they paid Aquila or that Aquila put in. They pay her 1%. They charge me 10. They make the difference. That's called arbitrage, right? You're making money on active money. So they pay her 1, charge me 10. They make 9. That's called arbitrage. So with infinite banking, the mindset is we want to replace the bank with you. You are now the bank. You want to participate in arbitrage. So now what happens is you can no longer think as just a consumer for the bank. You got to think as if you are the bank. Does that make sense, everybody? Right? And so I know we're going to talk a lot during the chat, so we're just going to treat this like an IG live, right? So if y'all with me, you could type a Y. If you have a question, type a Q. You know, we're just gonna rock it like that. That way, everybody's on the same page. Since a lot of us aren't available. But I just want to make sure that makes sense. Now, the second mindset you need to have is a compound interest mindset. Now, do me a favor. If you know what compound interest is and how money grows, just type a Y in the chat real quick. Type a Y in the chat real quick. Compound interest. So we all know that's the ability for your money to grow. And usually what that represents is, you know, you need money, you need time. And so that happens over time. However, listen to this, y'all. There's a piece of compound interest that people don't talk about. And in order for compound interest to work, your money has to be uninterrupted. If you were to go to Google today and type in dollar doubles 20 times, then you understand what I mean. For a dollar to grow to $1 million, it can't be interrupted. But you know what's crazy is the two biggest forms of interruption when it comes to people's money: losing their money in the market or withdrawals. If you currently have an account where you're constantly losing money and you're constantly pulling money out, so you're pulling from the principal, that means you're always starting the process over when it comes to compound interest, so you're never really harnessing the power. So guess what? You're losing out on money. That's why Warren Buffett, who's arguably one of the best investors of our time, says the number one rule of investing money is what? Never lose your money. Rule number 2, don't forget rule number 1. And the reason why he said that is because he understands compound interest. Is this an aha moment for anybody? Is this helping anybody? So when you want to harness the power of compound interest, you can only harness the power where if you have your money in an account where you don't lose your money to market volatility and you never spend your principal. Type a 1 in the chat if you're still with me. Type a 1 in the chat if you're still with me. All right. So perfect. So with that in mind, I appreciate you. I appreciate you. So so with that in mind, here's the other thing. When we talk about infinite banking, you guys might have heard of infinite banking, family banking, max funded insurance, velocity banking. All these different terms are basically the same concept, just with different names. So I want to make sure I don't confuse nobody, or if you go look something up on your own, the concepts are still the same. Furthermore, let's talk about how it works. Traditionally, let's see. Oh, Kim just popped in, Kim B. So let's pick on her. So if Kim has 100 grand in a savings account and she pulls out 30, how much money does she have left? 70,000, right? So then the 70,000 earn a minimal interest and she's able to do what she does with the $30,000. But if she had 100 grand in an infinite bank and she borrowed 30, how much does she have left in the account? She still has her original $100,000 in the account. Compound interest mindset. She never spent her principal. Uh-oh. If this is connecting the dots for anybody, drop a 2. Whenever you feel like it's connecting dots, go ahead and drop a 2. So now we got the original 100,000 in the account still. Not only do we still have the original 100,000 in the account, but it's still earning 8 to 12% interest. So essentially, what did Kim do? She created $30,000 for herself. The banks do it all the time. The banks do it all the time. So she created $30,000 for herself. So essentially, she has $130,000, right? So that's the power of infinite banking and how something like this will work. So now when people hear this, the first thing they ask is, well, how the hell does that happen? And so let's go into detail about it, right? Let's go into detail about it. Well, first off, we need to make Kim the bank. Here's what we know about banks. If I were to talk to you, well, you know what? Here, let me see who I could talk to. Let me pull somebody off mute, right? Let me pull somebody off mute. MK. Where you at, MK? Can you unmute?
Yep, I'm here.
Perfect, perfect. So when you think about safety, especially when you're putting your money with banking institutions, what comes to your mind? What comes to your mind when we talk about safety?
Bonds.
Bonds, okay. Does FDIC ring a bell to you as well?
Yep.
Yep. Now, here's the thing. Do you know what FDIC stands for?
Federal Deposit Insurance Corporation, something like that.
Okay, you hot. All right. She in there, y'all. She in there. So what that means is, see, and the reason why this is important for us to point out, most people don't know that. A bank is insured by insurance companies. Okay. And that when they're insured by insurance companies, they're insured up to $250,000. Now, if the banks are insured by insurance companies, then shouldn't we insure MK as well? And I'm not talking about her life, I'm talking about her money, right? And so now, with that being said, that's an idea, that's a concept, but now let's get more specific. Sean said earlier he was taught that life insurance could benefit his family when he passes away, which is true. This is what we were all taught. But did anybody ever know about life insurance being an asset? Okay. So in other words, I'm gonna pick on MK one more time. MK, have you ever banked at one of these banks before?
Yeah, I actually used to work at JP.
Okay, all right. And did they ever offer you life insurance asset accounts?
I don't know. It's a good question, actually. I know that at my current job, they offer me life insurance. I don't know if it's an asset account. I'm going to say no.
Yes, and that's the key, because most of the time we know about life insurance from the liability perspective, where we're just paying into something and we don't get the immediate benefit, right? But check this out, y'all. If life insurance is a liability where you can only benefit when you die, why would banks have over $56 billion worth? And that's not the death benefit, that's the cash. Now let's investigate this a little bit further. The FDIC allows this asset to be classified as tier one capital, which is the safest capital a bank can have. So now when we think about it like that, okay, so if we have our money with an insurance company, it's the safest money out there. And the reason why I say that is because everybody always says, well, Sonny, what about my money? What about my money? I want it to be safe. I want it to be safe. Here's a question, and I'll pose that with MK as well. Would you rather have your money be insured by the bank up to $250,000, or would you rather have your money be insured by the company that insures the bank dollar for dollar? Just that simple, y'all. Oh, you can answer, MK. I saw you on mute. Go ahead. It's always funny when someone else answers.
No, go ahead.
Well, with that in mind, that's so one of the terms that you guys could Google is called BOLI, bank-owned life insurance, right? You could also look up COLI, but you can't type in the acronym because something else comes up. So just type in corporate-owned life insurance, right? And so the reason why this is important is because if we're gonna make MK the bank, or we're gonna make Aquila the bank, we got to make sure that they're insured, their money's insured, just like the bank's money's insured. But instead, we're not going to do it up to $250,000. We're going to do it for however much money they have in the account. Now, next, with that being mentioned, we talked about corporate-owned life insurance. Well, here's a funny thing. This is a proxy statement, you guys. So you could look up. So what you could do is you can go to Fortune 500 companies, and you could choose some of the companies and look them up and see where the executives are placing their funds. Now, not all Fortune 500 companies put their money in life insurance, but you know what's crazy? A significant amount of them do. So this is AT&T, their proxy statement, and life insurance premiums applicable to the employee's death benefit. $217,000, $96,000. I have a question. Do we think anybody's going to pay that kind of money just to benefit their family when they die? Well, let me tell y'all, in case you didn't know, the answer is no. That is not what someone's going to do. They're not going to just pay that kind of money just to benefit their family when they die. So with that in mind, also you can see here where with the NEOs and split dollar options covered through life insurance, why would wealthy people put their money in life insurance type accounts? Because now it becomes a tax shelter where they could pull that money out tax-free. Write that down in your notes. But I know this is not revealing, so let's go to another one. GE proxy statement. These are the executives. You see their total income over here, 24 million in 2019, 10 million, 23 million, so on and so forth. Now, what you're going to notice is, let's see who I can call in here. Rachel, I saw you just pop in. Can you help me out right quick? Let's see if Rachel can help us. Oh, I guess she can't help us. What about Kels? Kels, can you help?
I'm here. I'm at work, so you might hear something in the background. What do you need?
All good, all good. So we noticed that with retirement savings plans, how much, what do you notice about the amount that's going towards this money with retirement savings plans?
Going down from top to bottom?
Yep.
Well, I would say it was decreasing, but I see from 19 to 84 and then to 98.
And in comparison to the income they make with 23 million, 7 million, would you say that's a lot of money being saved into those accounts or a little bit?
A little bit.
A little bit, right? Now, if we look to the left of that, you notice 61,000, 351,000, 41,000. Where's that money going towards?
Premiums.
Exactly, you guys. Now, the reason why this is important is because if we were to look at this, the retirement savings accounts, these are your 401ks. These are your 401ks. If we have any employees on the line, guess what? You've been told to put your money in 401k type plans, deferred comp type plans, but the executives don't even do it themselves. They put their money somewhere else. So basically, and you don't have to take my word for it. All you got to do is read right here, life insurance premiums and retirement savings plan. It tells you what it is. Now, based on that, here's my other question. So I'm coming back to you, Kels. If we want to be wealthy someday, does it make sense to do what the wealthy does with their money? Let me ask you that, Kels.
Yes.
Based off what you see here, where should you be putting your money?
Not where I'm putting it at in real life. I tell you that.
Right? And so again, I'm just showing you this because it provides perspective. Because like Sean, I too thought insurance was just a liability, right? Or something that could benefit when I pass away, until I started realizing where all these people were putting their funds. Okay. So that's why this is so important. But moving on. So how does something like this work? Well, if someone like Kel said, well, shoot, I'm saving my money in my 401k, I get tax write-offs, I can leverage the stock market, so on and so forth. Well, here's a question that I would ask or pose. And by the way, if at any moment you feel like this is we connecting dots or you're having a revelation, just type a 2 in the chat. Type a 2 in the chat because it's easier to do that, right? What's happening is, did you know that you can get insurance on your money, right? So let me give some more context to that. When it comes to investing for our future, when it comes to putting ourselves in the best situation possible, what is the biggest fear that most people have when it comes to investing their funds? Losing their money. So if we could show people how to invest for their future without the risk of losing their money, are we helping them? Right? Now, what I mean by that specifically is you can invest with insurance companies to where they'll help you get insurance on your money. Like you see here, there's a strategy called indexing where it'll mirror an index like a S&P 500 or a NASDAQ or something, depending on the company you use. And when the market goes up, you earn with the market. But when the market falls, your account's going to lock in that value, guarantee you don't lose a dime. And then when the market goes back up, you earn with the market again. So essentially, again, what that means is you're investing without the risk. Now, what's the trade-off, right? So if you don't have no risk due to market fluctuation, what's the trade-off? Some companies are going to cap you at 12 to 15% and give you a little cushion at the bottom. So if the market drops, you get like a 0.75% floor. But other companies will say, okay, all right, well, check this out, Matt. When the market does 30%, you could take all that home. But when the market drops, you have a 0% floor. So you don't lose anything, but you don't earn nothing either. So it's all about your choice and what you want to do. So the way you want to think about this, though, is, let's say we're talking to Matt P, and they're saving their money into an account like this. And when they're putting their money into this type of account, any money that's in this account is no longer considered an asset, technically, right? And the benefit behind that is this is the house of Matt, the bank of Matt, and every bank has a roof, right? So that roof, just like in my home, I have a roof that protects me from outside elements. When you have your money in an insurance with an insurance company like this, and you have that roof, which is the insurance companies, they're protecting you from creditors, predators, tax liens, bankruptcies, malpractices, judgments, and lawsuits. So now your money's been privatized, and it can go to whoever you want it to go to, right? So now it can grow. Now that differs per state, depending on how private and how protected it is. But the main thing is now you can have your money grow for you, work for you, and do things for you that it couldn't do in a 401k or IRA. Not to mention, if there's any single parents on the line, or if you know anybody that's a single parent, who do we usually make, or who do single parents usually make their beneficiaries? Their children. Did you know if you were to pass away and you had your children as a beneficiary on a 401k, they will not receive your funds? I'm going to say that again. If you are a single parent, or if you know of a single parent and you put them as a beneficiary, they will not receive your funds. It'll go to probate first, and then it'll get hung up, and then you have to pay attorney fees, legal fees, and probate fees, and then you get everything back plus taxes. You're looking at 30-40% of your money gone off the top. I know somebody who's been struggling with probate for over 2.5 years, but they don't tell you that. They just tell you write down a beneficiary. Well, the reason why that is because 401ks and IRAs are public accounts. They can't even be covered by your trusts, right? So that because a beneficiary is signed. But when it comes to this type of plan, it avoids probate because they're utilizing the mechanisms of insurance, right? So if our goal is to leave money to the next generation, does it make sense to put our money somewhere where no one else can get it? Absolutely not, right? Is this helping anybody? Did the light bulb turn on for anyone? The only person that can inherit your funds tax-free is your spouse. Everybody else goes to probate first, unless you put your money in an account like this. So now it could be, now you have protection where it can go to your family. This is one of the only accounts where it has 3 tax codes attached to it, where your money can grow tax-free. It could transfer to your loved ones tax-free, or whoever you choose, or whatever you choose, because it could be an organization as well. But then also you could withdraw your money 100% tax-free. Whereas with a 401k, you just have the tax deferred benefit, but none of the other benefits I just named. This is the only vehicle that has all 3 combined into one. So with that being said, you could customize this plan to be a protection plan, an emergency plan, a retirement fund, a college fund. Listen to this. If you got babies and you want to send them to college, I know a lot of us are doing 529 plans and things of that nature, but with the 529 plan, they have to go to a university. It has to be spent with the school, no flexibility or anything like that. Well, when you have your money in these accounts, first off, you could have $100, $200, $300, $400,000 in this account, and none of it will count against their financial aid because it's not seen as an asset. You're being protected by insurance companies because of the roof, right? So that's like we go on to Google Maps and look at your house from a bird's eye view. We can't see inside because the roof is blocking it. Well, that's what insurance is doing to your money. It's creating an electric fence or a private wall where no one else can see inside of it. So you can have 200 grand in this account and your baby can still qualify for financial aid because technically this money can't be included. Now, the other thing is if you want your baby to open up a business, you want them to buy a car, you want them to buy their first property, they have the flexibility to do all that in an account like this where they don't have that flexibility within the 529 plan. But then the last one, you can also customize it to be a savings where it becomes the bank of Matt. And that's what we're going to get into more detail about in just a minute. But let's take a temperature of the room real quick. How's everybody doing with this information so far? This good stuff? This helping out? You all right? Is it going over your head? Is it boring? Right? Let me know how y'all feeling. Go ahead and say something in the chat. Let me know how y'all feeling. Solid, solid, solid. All right. Well, I see a couple twos in the chat, which means we connecting the dots. Perfect, perfect. Solid, solid. All right. So let's go ahead and keep moving. So once you identify that you want to open up an infinite bank, then it all boils down to your strategy of how you're going to fund it. So there's 3 ways that you can fund it. And for the new people that came on, when people drop twos, that's when aha moments are coming off, dots are being connected, like they getting something, they feeling something, you know? Now, so the 3 ways you can fund an infinite bank is monthly, front load, and max fund. So a monthly strategy, just like it sounds, is monthly or annually, but now it's just like your 401k, just in a different account. So this is a long-term strategy. I tell people, think of a 30-year mortgage, right? So you're going to contribute to this for 10, 15 plus years, right? Front load is where you have a lump sum and you put that money in up front and then you contribute monthly or annually thereafter. Whereas max fund, so now, and so with front load, that becomes a 10-year or under strategy, depending on how much you put in up front. With max fund though, now what you're looking at is, you imagine paying the maximum into an account, and based off you putting that money to the account, basically you can max fund an account for 3 to 7 years and never contribute to it again, and you still receive huge benefits. Now, I know this may not make sense right now because we're explaining the abstract, so let me give you some numbers. But I don't want nobody to be intimidated by these numbers. I want it to make sense. So if we look to the left, we have a legend of 1 through 5, and then to the right, the numbers are correlating to that legend. So part 1, the contributions of this person who's 40 years old is $2,000 a month. Now, the first power in that, they couldn't do that in a 401k or an IRA, a deferred comp plan. If they're self-employed, they can get a SEP IRA, which I believe the maximum last time I checked was 55,000. It might have gone up since then, but my point is right now, the reason why I show this is just to let people know you could do more than 18,000 a year, right? And then of course, if you're older than 50, they give you extra, but it still ain't nothing. So my point is, this person's contributing 2,000 a month, which is 24,000 a year, and you see they did it for 27 years. In circle 2, that's how much money they have access to within the first year, right? And actually, it's like 12 months and 1 day. Circle number 3, if something were to happen to this person, their family would be awarded $1.3 million. Okay. And then circle number 4, remember, because we're looking at contributing to this for the long term, in 15 years of contributing, they would have $425,000 in their account. But listen to this. They can leverage that money to purchase real estate. They can leverage that money to do whatever else they want to do tax-free. Circle number 5, after it's all said and done and they hang up the cleats, they get that money back and they have a certain amount saved. And so what it does is it pays them $95,000 a year in income, tax-free. Is everybody with me so far as how this works? Drop a 3 if you're still with me. Drop a 3 if you're still with me, just to make sure that I didn't lose nobody, because we talking numbers now. So just want to make sure that everybody understands what we're talking about and how something like this works. Okay, perfect. We got 2 more people that's with me that understands, because if not, I'm gonna stay on the page so that we can make sure everybody understands. But it's 2 more people getting it. Drop a 3 if you good. And you got it. Because if not, I'll just sit here and ask you guys what questions you have about this. So again, I didn't hear you. Tanisha, you have a question? No? Okay. Does anybody else have a question about this so far, or are we good? I'll go ahead and move forward if not. All right. So so this is an example of monthly funding. The next example is front load. So with front load, remember, we said all we're going to do is put in a lump sum up front and then continue to pay or contribute are monthly contributions. So in this example, all they did is put a $20,000 lump sum up front, and they're continually saving $2,000 a month. Well, look at that. So now you see the $20,000 with 44 grand. You also see that they have access to more money within the first year under circle number 2. But most importantly, in circle number 4, that's a $40,000 difference, not a $20,000 difference compared to the first example. Because now it's 462 instead of 425, right? But even more importantly, from putting an extra $20,000 once, you get a $6,000 difference in income for the next 25 some odd years. That's 150 grand that you're getting extra total tax-free, all because of how much money you put into the how much extra money you put in up front. Okay. Now with the next part, this is called max funding. So with max funding, what happens is there's some tax laws attached to this plan. So from this person saving $2,000 a month, the tax law allows them to create, or it automatically creates a floor and a ceiling of how much they can contribute. So from that $2,000 a month or $24,000 a year, the maximum that they could put in is $90,000. And whenever you have accounts like this, the closer you get to the maximum of what you could put in, the better these accounts work for you and the more benefits you receive. So now this is the exact same policy or the exact same bank. However, now they're max funding it. So with them max funding it, they're getting $90,000 a year or putting $90,000 a year into the account, but they only did that for 5 years, ladies and gentlemen. Only did it for 5 years. So first off, they get access to more money. They have a $300,000 difference in year 15 compared to the prior 2 examples. But even more importantly, they have more than $21,000 difference compared to a monthly strategy to a max fund strategy, right? So that's why this is so powerful. So I use these examples just to show people the power of what it would look like as far as how you would want to strategize. And so just to put everything together, when you are designing your plan, you say, okay, my goal for infinite banking is, right? Whether it be investing in real estate, whether it be opening a business, expanding your business, whatever your goal is for infinite banking, we want to make sure that you can fund accordingly. Does that make sense, everybody? Right? So, for example, with monthly 648,000 is the total contributions, you got access to 65% of your money within the first year, and you got $95,000 in income tax-free, right? Front load, total contribution 668. You get access to almost 80% of your money, and your income is almost a $6,000 difference. Max fund, your total contributions is $450,000. You get access to almost 90% within the first year, but you get a $21,000 increase in income, and you put in less money over less time. Why? Because I think of it like a snowball at the top of a hill. If we start with a small snowball, it'll grow, but if we start with a bigger snowball, the snowball at the bottom of the hill will be bigger. Same thing with compound interest. The bigger the number you start with, the bigger the number you end with, and you need less time, right? So that's the mindset as far as how you can fund these accounts. Now, here's the good news. Let's say Tanisha wants to start funding with a monthly strategy. Does that mean she's locked into that strategy and she can't do a front load or a max fund later on? No, it doesn't mean that. These are fluid, not stagnant. So, or let's say that Kim starts with a max fund, but then something happens where she has to switch to monthly. We have the ability to switch in and out. The reason why it's important to identify this, though, is so that now you understand how you could benefit or plan properly for your goals. Does this make sense to everybody? Do it again. Drop a 3 in the chat if you're still with me, just to make sure this is making sense, so I'm not talking over nobody's head, right? Because I know when numbers get involved, that's when less people pay attention. They're like, ooh, numbers. Hold on, right? So how does this work? Perfect. Okay, appreciate y'all. So how does this work? Loans is what makes the concept work. So remember earlier when we said banking mindset? Well, if I didn't talk about a banking mindset and I told Akila, hey, Akila, you put 100 grand in the bank, get a loan against your own money and then make some money off of it. She'd be like, fool, I ain't doing that. Why? It's my money. Why would I do that? Right? But when we understand the banking mindset is we're paying a little bit of interest so that we can make more, right? Based off our prior example, they're paying Akila 1 so they can make 9, right? And to be honest, if you just making 3 when you paying something out, you winning, right? So with that being mentioned, loans is what makes it work. So what companies will do is they'll say, okay, let's say you have money in your account. Well, let's go back to this example so you guys can see it. So by circle number 4, there's $742,000 in this account. All right, so Akila, I'm gonna pick on you right quick. Can you unmute?
Okay.
Perfect. So Akila, you have $742,000 in your account. So you talk to the insurance company and you like, yo, I got $742,000 in your account. I want $700,000. What are they going to do to make sure you can get it?
I'm not sure. I guess I'm used to a standard loan process. Show me your documentation, your credit.
You're right. That is the standard loan process. But that's why I asked that, because in this case, they don't do that. They say, Miss Akila, you say you want $700,000? Okay, how would you like it delivered to you? It'll be wired in 3 to 5 business days. They don't check your credit. They don't check your business standings. You have the money right there. Now, here's a more important question though, Akila. You have $742,000 in your account. They just wired you $700,000. So now you have $700,000 in your hand. How much do you have left in your account?
The 42K.
Uh-oh. Somebody help her out. Somebody help her out. Somebody help her out. How much do you have left in your account?
Or is it the 1.8?
Nope, it's the 700. It's the full amount of 742,000. Because with infinite banking, even though you have 742,000 and they give you the 700,000, you still have the total amount in your account. Now, why on earth would an insurance company do that? Because they're going to say, okay, we're going to give you 700,000 because you're good for it. You have it in the account already. And then we're just going to charge, the average rate I've seen is 5%, right? So now if you have a loan out for $700,000, remember, here's the trick of the trade. In this whole process, who's the bank in this process? You are. So here comes my next question. Whenever people hear the word loan, they always ask when do they have to pay it back? So I'm gonna ask you a question, Akila. When would you require you to pay yourself back that $700,000?
Well, if I'm requesting the money, I already have a plan for it. So I guess I would probably start repaying it within 6 months.
Okay, 6 months. Now, what if something happens and you don't meet that time requirement? Are you gonna penalize yourself?
Nah.
That was a trick question, y'all. Thank you for participating. The key of the matter is she could pay it back whenever she wants because she's the bank. She sets the rules. So let's say she just goes ham and she don't ever pay that thing back because she don't care. YOLO, I'm gonna live it up. I'm gonna do whatever I'm doing. I don't care what the ramifications are. Well, then what happens is when she passes away and she never paid that $700,000 back, the bank or the insurance company, see that death benefit over there for $1.8 million? They're going to pay out that $1.8 million to the family, tax-free, by the way, minus the $700,000 that she owed. So now what that means is she enjoyed her life, her family they still get the proceeds, and the insurance company got their money. So everybody's happy. That's why it's important to make sure you do this through insurance companies because they utilize your death benefit as collateral. I hope this makes sense to y'all, and I hope this just turned on a light for somebody. Oh, never mind. I got somebody. There we go. It turned on the light for Aquila. I appreciate you, right? So that's how something like this would get down. So now that's why technically you don't have to worry about paying yourself back. But do I recommend it? Absolutely. Here's why. If you could pay yourself back and make extra money, why not? Why not? Let me give you an example. If you had 742,000, and let's say you borrowed 42,000 and you bought a car. And then when you buy that car, you own it outright now, but instead of paying a credit union or a bank, you're paying your personal bank back. So Aquila pays herself back. Then what happens is her retirement income under circle number 5 will go up at least 15 to 25% because she's adding money on top of the principal that she borrowed from. All right. So with that being said, I just want to make sure I explain that. To everybody. So the death benefit or the roof over your bank is the most important part because that's what's used as collateral. That's what protects you from taxes, and you're able to use it as a legal smokescreen. So what that means is no one else can see your money but you, unless you're in like the state of California, but it's like a don't ask, don't tell state. So, one of those things. In other words, I could say, Aquila, I want to sue you. And I could tell her, list all your assets. If she doesn't include her life insurance, technically she can't get in trouble because it's a liability, not an asset. That's the benefit of the roof or the high-rise fence of insurance over your funds. So now here's the other thing. See, traditionally speaking, we think about insurance. When we think about insurance, we say, what's the minimum amount of insurance I could pay or money I could pay for the maximum amount of insurance? Well, with infinite banking, it's the exact opposite. What's the most I could pay for the least amount of insurance so I can max out my cash, right? And so the other thing I want to say, just out of full disclosure and transparency, when you hear about infinite banking, more times than not, you're just going to hear about it from the whole life side. So if you hear about it from the whole life side, here's a benefit to that. You get guarantees. So they have a guarantee of 4% plus dividends from the company. So that's usually about 8-10% total. You can access your money in 30 to 90 days, but you have to fund it for at least 7 years. Can't do nothing less. And the interest is fixed, right? So it's usually not going to go without a certain limit. On the flip side, with Index Universal Life, it's another product, another strategy. Here's the difference. With this account, you could fully fund your account in 3 to 5 years. You don't have to wait 7. You can manipulate the earnings to where you could take home the maximum of the market, which is like, so for example, we had a client take home 60% in March, just so y'all understand, right? You would never be able to do that in a whole life policy. But the trade-off is if the market were to drop, then you have a 0% floor. And if the market did bad for a year, then that means you can have a 0% return unless it has some minimum features like a 2 or 3%. And then the other thing is that you don't access your money for the infinite bank loans until 12 months and 1 day. So that's the biggest difference. So really, whole life is guarantees and access your money sooner. Index Universal Life is big returns, a little bit of a waiting period. That would be the difference. Me personally, I have an Index Universal Life. I like the returns. I like doing stuff like that. So that's why I went that route. So now that you understand how all this works and the benefits behind it, how do you qualify for a plan? Find a licensed professional like myself, plan how much you're going to put in, decide a number of years of contribution, go through the qualification process, and then fund it, right? But the catch to everything is because it's still a life insurance contract, there is an insurable need. So that means that you have to, so there's an insurable need. Any insurance agent knows that. You have to qualify for the account based off your age and health, not based off your income. So that's huge. Stick to your plan and minimize bad outcomes. What do I mean by that? If you purchase a bank, an infinite bank to help you leverage for real estate, then don't buy a car or send your babies to school with it. Get another one that can send your babies to school, right? Stick to your plan to minimize bad outcomes also would mean, for example, if you bought a luxury car, like a Lambo, you wouldn't go mudsliding in it because it's not going to perform well because that's not what it's made for. But if you hit the Autobahn on 120 miles an hour, you're going to be happy because that's what it was made to do, right? The other thing is the returns on an infinite bank are annual, not daily. So that's one of the biggest things. And then this is the most important part. Make sure your agent designs your policy correctly. What I mean by that is I told you guys about whole life and index universal life. The mistake that people make is they go to someone, they say, hey, do you have a whole life? Do you have an index? Let me get one of those. Instead of talking to them about infinite banking. And the reason why that's important is because now let's say Jamie wants to put 100 grand a year into their infinite bank. Well, then what's going to end up happening is the agent's going to get paid on 100 grand because they don't know how to set up an infinite bank properly. And then you're asked out because you're not getting the benefit that you originally were looking for. So with that being said, y'all, we're coming to a close. So let me ask this. When it comes to money-making ideas, does anybody want to learn about that part or y'all good? You guys want to learn about how to make money with infinite banking? If you do, just drop a 1 in the chat if y'all want to do that. Solid. Okay. All right. So let's talk about it right quick. Is there anybody that's a homeowner in the audience? Anybody a homeowner? Because if you're a homeowner, I could show you how to use your infinite bank to pay off your home a lot sooner. So let me what happened? There we go. All right. So most mortgages are 30-year mortgages. And I'm sure there's some people in here that listen to Dave Ramsey's. Let me say this. Mathematically, he tells people to get a 15-year mortgage because you can pay it off in 15 years instead of 30. Mathematically, he is right. However, that's your money. Why not keep a 30-year mortgage and then that money you would have spent on a 15-year mortgage, put it in an infinite bank instead, then allow that to grow interest. And based off the interest that you earn, you could pay off your home in 15, 20 years. Worst case scenario, let's say you mess up 25, right? But now what's happening, but what would happen is let me give you a better example. If you have a mortgage that's $3,000 on a 15-year mortgage, but it's $1,500 on a 30-year mortgage, right? Then instead of paying $3,000, keep the 30-year mortgage for $1,500, take that additional $1,500 and put it into your infinite bank. Based off that, you could be earning interest, and that interest that you earn, especially after 15 years, within that 15 to 25-year window, you should have enough money in there where you could pay your house off in one fell swoop, right? You'll have a lump sum big enough to pay your house off in one fell swoop, right? So now you don't have to worry about it. You paid your house off for the cheap because you leverage your account to earn interest. And so that means the stock market paid off your house for you, not you, right? You got to keep your money on hand. So that's one power. Finance cars, or you know what, before I get to that one, let me also say this. When it comes to mortgages and things of that nature, a lot of people say, well, Sonny, how can I find ways to fund my infinite bank? Well, I can't remember who it was, but we were talking about somebody earlier. I think it was Kels, where she said, shoot, I put all my money in my 401k right now. This is where I have my money. I need to get out of this. Well, one of the things that we could do is we could show her how to roll. So let's say she has 100 grand in her 401k, right? We could show her how to roll, let's say $25,000 a year for 4 years. And what we would do is look at the taxes, look at the ramifications, make sure that, it's not too detrimental. And then let's say from that, she owes, a certain amount in taxes per year. So let's do the math on that just so that I'm not telling nobody wrong. So let's say it's $6,250 based off 25% tax, right? So she's pulling out 25 grand a year. That's an extra $6,000. Where could she find that $6,000 a year? Well, first off, if she has a home, listen to this, y'all. If you had a home, isn't your interest considered a write-off? Okay, listen to me now. If your interest is considered a write-off, and let's say Kel's mortgage is only $2,000, That's $24,000 a year. And she calls a mortgage company and makes it an interest-only payment. She just created a $24,000 write-off per year. Now what that allows her to do is move the $25,000 from her 401k per year into her infinite bank. So now she's putting in additional lump sums, or she's max funding it in addition to what she's already doing, right? Now from that, let's say she does that for 4 years. Well, what that means is she's only paid interest, so she didn't pay no principal down on her home. So a lot of people are like, oh my God, Hasani, but what about our house? She's gonna have a huge mortgage up. No, everything stays the same. They just tack on extra years. But remember, if we keep with this strategy and she's max funding it, let me give y'all a quick example real quick so you understand what I'm talking about. In this example, all we did is add 20,000, and in year 15, they got an additional $40,000. So let's just say for every 20,000, you get $40,000, just for example's sake. Well, she's adding $20,000 for 4 years. That's $80,000 minimum that she's getting. Not to mention she could possibly be at over $500,000. Well, odds are she could pay off her house then. Does that make sense? And then when she pays off her house, she doesn't just pay off her house where she pulls the money out. She doesn't pull the 400 grand out, just for this example. She doesn't pull the 400 grand out, and then now she only has $62,000 left. She takes an infinite bank loan against it, pays the house off, and then she just goes ahead and pays herself back if she chooses to. And if she doesn't, she leaves it as is, and the death benefit will pay it off for her. Is this helping anybody? Is this giving a concept to anybody? Is this good information? Right? All right. So next, okay. So now with that in mind, let's talk about something else. What's really big in the marketplace right now is people getting involved in Turo or renting out cars and things of that nature. Is anybody involved in that in this group? Anybody looked into that yet? No? Okay. I won't spend too much time on that. But I will say this. If you were to have a couple $100 grand in your infinite bank, like, so going back to, okay, so you have discussed it. Okay, perfect. So let me talk about this. So going back to Kel's example, she has 100 grand in her infinite bank. Did you know that you could own policies? Or no. Yeah, let me say this. So Kel's has 100 grand in her infinite bank. She goes to the dealership and she says, hey, I got a group of people that's going to be getting cars for their rental fleet. They're going to be getting them from you. But when they get them from you, I want you to finance their cars through this bank. I'm sending them to you. So I'm sending you business. So you give me business. So now the bank of Kel's has 100 grand where she's going to finance Sonatas, right? She's going to finance Hyundai Sonatas, and they're 30 grand a piece. I'm just making up these numbers. That means she could finance how many? 3 of them. So now I come along and buy 3 Hyundai Sonatas and I get financed. What got it? My credit doesn't get checked because I'm going through Kel's. She just needs to know I'm financially responsible and I can pay it, right? Oh, by the way, because of that, I might have to pay a little bit more in interest, like 8 or 10%, but guess who I'm paying now? So Kel's has 100 grand in her account. She took out 3 $30,000 loans, but now she has me, Akila, and Jamie paying all that money back. That's passive income, you guys. So now she went to the dealership. She worked out a deal. The dealership is going to her to finance cars, and the people are paying her back. And what if they default on the loan? There's no risk on her part. The only thing I want to disclose, though, don't say, "Hey, Akila, I got you. I got a bank that you can get a loan from." I advise people to create an entity that is separate from you, and then the entity utilizes your infinite bank. Does that make sense? So that's just another way to finance cars and make money from it, right? But then, so with that same, the reason why there's no risk is because even if they were to default on the loan, when do you have to, even if they default on the loan, Do you have to pay that money back? Are you on the hook for that money? No, because it can be taken care of. You can live the rest of your life out and just say, man, I took a loss. I don't want to do anything else. It'll be paid through your death benefit. Because you took it out via loan, so the principal is still earning interest anyway, right? So that's what I mean by that. Now, ideally, you don't want to be in that situation, but I'm just saying conceptually, it's not a risk, but you can put yourself in a position where you can benefit from it. So, but same thing comes to being a hard money lender for real estate deals, business deals, and all those type of things. You could set yourself up to finance these deals instead of just doing these deals. And now you have passive income coming back to you. So that's what I would say, y'all. These are just a couple of ideas to put it out there. I mean, I could also explain to people about college scholarships and how to put yourself in a position where you can pay money into an endowment fund with a college and they pay you in perpetuity. But because you pull from your from your infinite bank, the money you pull out is tax free. And then because it's an endowment, they pay you tax free. But we'll talk about that another time. Right? So with that in mind, y'all, the only extra thing that I want to tell you guys, what if you don't qualify? Because the truth of the matter is in our communities, we're dealing with a lot of hypertension, heart disease, kidney failure, all these type of things, right? So sometimes we may not be healthy enough to get one of these accounts. And the truth of the matter is some of us are afraid to apply because they're like, my health is the shits. Like, how am I going to benefit? Let me tell you something. There's always a workaround. Did you know you can own a policy on someone else? And when you own the policy on someone else, you could exclusively retain the rights to the cash. Drop a 2 in the chat if I just lit your world up right now. Right? I know a gentleman who has 142 policies, and they're not all on him. Older white dude. I mean, his health is generally okay, but not okay enough to get 142 policies. He has 142 policies because he insured everybody in his family, a couple of business partners, and he maintained the rights to the cash so that he can create a funnel system of how that cash circulates, right? So with that in mind, how can you own a policy on somebody else? There must be an insurable interest, which means immediate family, or a business interest, which is the most popular. And then you fund, and then you still have exclusive rights to the plan. So with that being mentioned, you guys, there's no reason why you can't get one. No reason whatsoever, right? No reason whatsoever. And so with that in mind, with that being said, everybody, the last thing I say is everything I do is 100% referrals. So if you know anybody that can benefit from what we're talking about, please let me know. And I always send people small referral gifts where, up to $100 gift card, because we can't do more or else we'll lose our license. But if you want to get your license and you refer it, we can split the commission 50-50, or I can show you how to open up an additional financial agency and have people operate and open and run infinite banks for you in your business. And you have a whole new financial arm now. Because one of the things I'm getting ready to launch is a whole mentoring system where we'll show people how to have an in-house agency, and we take care of the training, the liability, the payroll. All you got to do is identify the talent. We don't find the talent for you. So we show people how to do all the above, right? Now, naturally, you still got to qualify to work with a broker or work in the finance industry. So they do a background check. You get your license with whatever state you're associated with, and then that's pretty much it. Here are some resources that you guys can go into further. And basically, so take a picture of this page. And aside from that, my Instagram, I would definitely say that's another spot that you guys can hit up as well. So take a picture of this page. One of the things I would definitely recommend is Laser Fund by Doug Andrew, Becoming Your Own Banker by Nelson Nash. Those two books are probably the ones I would recommend first because they're some of the best. And then last but not least, y'all, follow me on Instagram. I'm always updating stuff and giving you more ideas about how to utilize infinite banking to improve your situation in your life, not just buy it and it just sits there and does nothing. I show you how to utilize it so you can get the biggest benefit. The other thing is text bank to 510-327-8698. And basically you become part of the infinite banking family, where I'm constantly sending you updates and things of that nature as far as what we're going to be doing on Instagram. I'm going to be dropping an ebook soon. So everybody's in the infinite bank family, they get to know about this first. And so that's pretty much what we're working with. But with all that being said, y'all, if anybody has any questions, now will be the time to let me know, and I'll be more than happy to answer some questions for y'all.
And also, he does like lives on Friday nights, Friday evenings, and afternoons.
Oh yeah, that's right. Yes, indeed.
Yeah, I peeped that.
That's a new thing I was picking up. Finance Fridays, questions about infinite banking for anybody.
Yeah, does anyone have any questions, anything like that from the information that he's reviewed, or any other things that you might have concerns or questions about?
Y'all a quiet group. Y'all make this easy. Okay, well then, how about this? Can y'all just give me some feedback about what you got out of today? Was it cool? Was it all right? Did you learn something? Was it boring? And by the way, if y'all don't say nothing, I'm gonna start picking on people. I'm just letting you know. At least 3. Perfect. Perfect.
I have a question real quick, but I'm not sure if you touched on it, but I can't remember from before when we spoke, the 7 pay.
Mm-hmm.
I think it was the max. How was that defined again, the max and the minimum?
So those are defined by the tax laws. So let's say you can, so for example, with the example I had where you save $2,000 a month, the tax laws will create the ramifications for you. But it's basically customized by you. You know what I'm saying? In other words, what that means is if you're saving $2,000 a month based off your age and your health, well, then they'll say, okay, the maximum you could put in is $90,000 a year. They'll do something like that. Uh-oh, can you guys still hear me? I got a phone call. I'm sorry. Can you guys still hear me?
Yeah, I still hear you.
So the tax laws is TEFRA, DEFRA, and TAMRA. Those determine the maximum and the minimum that you could put in based on how much you could save, right? So the biggest benefit to these type of accounts is they are customizable customizable, where depending on how much you can save will determine your maximum. So somebody who saves $250 a month, their maximum might be $1,000 a month. Somebody who saves $1,000 a month, their maximum might be $3,000 a month. So it's all dependent on how much you're putting in, and it's all customizable based off your situation. So you don't have to save $2,000 a month. That's just an example that I give people, but I also show them how to get that $2,000 a month and find that money. Does that answer your question?
Yeah, I got it.
Perfect. All right. Well, then, if there's no other questions, y'all, well, feel free to text me and let me know, or DM me and let me know if you do have questions, or feel free to lock in when it comes to the Finance Fridays. You guys can go ahead and lock in there, and then we pretty much pick everything up from there, and we'll make it happen. So pretty much with that being said, y'all, I appreciate y'all's time. Anything else that anybody needs me to cover or talk about? Are we good?
Yeah, I think we're good for now. I don't see anyone with any questions in the chat or anything like that, but definitely appreciate your time, Hasani.
Most definitely, brother. Most definitely. Thank you, everybody else, for your time as well. Definitely appreciate it. Y'all have a phenomenal day.
All right, everybody. Have a good one.
All right. Thanks a lot.